In this lecture, we're going to be discussing what's perhaps the most significant thing a company can do, and that's to maximize cash flow. While it's traditional to say that the bottom line is what matters, that is profits, none of us can be paid in profits. We have to be paid in cash. And so while profits are a nice thing to report if you're on a bonus system, the reality is it's cash that's king. We're now, therefore, going to turn our attention to the idea of cash flows. Many companies have finally discovered this, and it's become quite an issue, and I'll talk about it a little later. Cash flow is calculated simply on your screen by adding back to the profit after tax the non-cash expenses that we incurred in generating those profits. Certain costs that we deducted from the income statement in order to reduce our reportable income and hence our taxes were not actually cash expenses. We didn't reach in our pocket and spend that money. A good example is depreciation. The money was spent on equipment when we bought it. The depreciation charge is just our way of attempting to recoup the cost of the equipment by writing it off and saving a little bit in taxes each year by the write-off of the depreciation expense. So cash flow would include not only profit, but it should certainly also include the depreciation charge, which was not a cash expense. Amortization of goodwill, amortization of patents, amortization of copyrights are also non-cash expenses. Those costs were incurred when we invested in those assets, and we're simply trying to find a way to recoup them. All of these then represent attempts to increase cash flow. So that, for example, if we looked at the XYZ company, our example again, we noticed that the profit after tax that they reported in 1995 amounted to some $14 million. To get to how much cash flow they generated, we would add back the non-cash expenses. The only obvious one in the income statement of XYZ is the depreciation charge of some $7,000. So in reality, XYZ generated $21,000 of cash. And cash is what you can use to spend to pay wages and do other nice things, including buying other companies. You can even pay dividends out of cash flow. So cash is king, and we're going to pay a lot of attention to that. The reason it's become so important is that many companies find that because they don't manage cash flow, they end up not managing their assets properly. One idea that we might spend a moment with is the concept of working capital. Working capital is simply defined as the difference between current assets and current liabilities. That is, how much money, short term, do we have to put up in order to run the business? Remember that we'll assume that all the fixed assets can be financed with either debt or equity. But somehow or another, we have to come up with some money to run the business with, to finance the inventories, to finance the receivables, to run the cash. Part of that is offset by the fact that we can borrow from you managers who are willing to loan us your wages or salaries for a while. We can borrow from our suppliers in the form of accounts payable. Remember, we said we could borrow from the tax collector in the form of taxes payable. So a number of things help to reduce the amount of money we have to come up with for working capital. But the working capital calculation for XYZ, they had current assets of $25 million and current liabilities of some $14 million. And so they had to produce somehow $11 million of cash to operate the business, either by additional borrowing or some other means, equity being the other principal means. The management of cash flow has become, and working capital has become a major issue in companies. Tying up money in working capital is an expensive process that in itself doesn't earn money. You have to do it because indeed you have to finance sales, indeed you have to carry inventories, indeed you need cash around, and in some cases you have to prepay expenses, offset admittedly by current liabilities, but all the difference we've got to finance. And so companies are now beginning to charge their subsidiaries for the use of working capital. Just to remind you managers that working capital matters and you're going to have to pay for it. One company that I consult to charges its managers 12% for the use of working capital. That comes out of the division's bottom line and reduces the amount of bonus that you earn if you use too much working capital. So a lot of energy is being used to try to figure out what to do to improve working capital and hence also cash flows. What can you do? Well, among other things, collect your receivables faster. Don't carry excessive inventories. But remember, the question that we dealt with each time was, does it matter to anybody? And the answer is, of course, it depends. If we cut inventories, yes, that reduces our working capital requirement because current assets have gone down when we cut inventory. But on the other hand, if we cut inventories, our customers aren't very happy with us because we're not as reliable a supplier, especially a just-in-time supplier. We could cut receivables, that is, make them pay faster. But of course, customers don't want to pay any faster. So there's a push and pull in all of these things, and we don't want to alienate the customers. In fact, you can bet that the sales managers in the audience will be very much against reducing the collection time because that makes it harder to sell. The competitors are offering better terms than we are. Finally, you might pay your payables slower. That's one way to increase the current liability item and hence reduce the amount of money we need for working capital. I think I've already alluded to, but one way to pay slower is to make sure that we don't pay for anything until it's perfect, which means we have to have a serious review. We have to look with pride and view with alarm at everything that comes in the door. We have to consider whether it's all there, whether it meets specs. If any one of the items is bad, we don't pay for anything until they're all paid for. And remember, we only write checks on Friday afternoons so that we get additional grace period on the postage. So all of these things are meant to increase, or rather decrease, the amount of working capital used because that frees up cash for other uses, and that's part of cash flow too. The use of cash that's available because we freed it out of other assets where it wasn't as productive as it should be. Now, how do we know how much we should have in working capital? Well, there's several approaches. The basic one is benchmarking. What do we look like compared to competitors? And it's an interesting exercise to try to figure out which competitor we ought to compare ourselves to. Better yet, which competitors should we compare ourselves to? From a middle manager's viewpoint, this is tough business because we might decide that there are 5 companies to which it would be logical to compare our business. And we could take the average of their figures and see what kind of working capital requirements they have to support their sales and say that's what we ought to do. But of course, the general manager of the business, the president, would probably say, now wait a minute, we ought to do as well as the best. So then we take a look at the 5 and see who did best, and we're supposed to do at least as well as the best guy. That wouldn't be too bad if he told us we had to do as well as the best guy on the overall figure working capital. But how about if we had a separate benchmark for days of receivables, amount of money tied up in cash, days of inventories, and days of payables, and we had to meet the best criteria on each of them? Well, that's like walking on water. And of course, that's all we expect of you middle managers. And the senior manager's job is to crack the whip to see that you do it. There are other non-cash expenses that I think I should mention. Remember that depletion is also a non-cash expense. It's just a tax vagary. Now, there's some other things that will affect cash flow that we have to look at. We sort of talked about it before, but now we have to talk about it in more detail. Remember that in the first session we talked about how we maintain inventory valuations on either a LIFO or a FIFO basis, last in, first out, or first in, first out. And we discovered that the principal advantage in using LIFO is that it reduces our taxable income because we're selling the most recently acquired inventory, which was acquired due to inflation at much higher prices, so we report less income to the tax collector and pay less taxes. On the other hand, we decided we'd report FIFO, first in, first out, to our shareholders because that would make them feel good about what a great profit we're generating. Well, in addition to affecting profit, the choice affects cash flow. Let's see if we can illustrate that. The year is 1491, a period of very high inflation, I must tell you. Columbus hasn't yet sailed, and they haven't discovered gold in the New World. We've decided to open a shoe store. You know what shoes looked like in 1491? They all curled up in the front, and they all looked alike, and they were all the same size. If you wanted to make them fit, you just stuff something in with your stocking. We decided to open a shoe store, and we're going to need 3 pairs of shoes in inventory in order to open the store. So we go out and we acquire our first pair of shoes, and we pay 100 shekels for them, or whatever the unit of currency was in the country we're in. The next day, we buy a second pair of shoes, and we pay 120 shekels due to inflation. And on the third day, we buy still a third pair and pay 140 shekels. So we now have a 360 shekel investment in inventory. We can't tell one pair of shoes from another. All we know is that there are 3 pairs of shoes that on average cost us about 120 shekels a pair. Now let's see what the use of a particular evaluation system for inventories would do to our results. A customer comes in and we decide we're going to sell shoes for 200 shekels per pair. And so we make a sale of a pair of shoes for 200 shekels. In order to calculate the profit, we have to decide what the pair of shoes that we sold cost us. What did it cost us? Well, if we use a LIFO system, last in, first out, then the pair of shoes we sold was the most recently acquired pair, the expensive pair, at 140 shekels a pair. So the cost of goods sold was 140 shekels, and we will have a pre-tax profit, profit before tax, of 60 shekels. Now, there may be other expenses, but let's keep it simple. We're selling at a roadside stand, so we have no rent or anything. And it's a mom and pop operation, so we'll just call profit our own salary, although we could easily take a salary out of this business if we wanted to. The tax collector, of course, wants his bite. Taxes are at 50%, pretty steep in this country. So taxes are 50% of our pre-tax profits, or 30 shekels, and therefore we have a profit after tax of 30 shekels. Now let's see what would have happened had we elected to go on a FIFO basis, first in, first out. In that case, when we sold the shoes for 200 shekels a pair under FIFO, the cost of goods sold would be the cost of the first pair of shoes we bought, the first in, which was 100 shekels a pair. And so we would have to admit to a profit before tax of 100 shekels. The tax collector, as usual, wants 50% of the pre-tax profit, so we give 50 shekels to the tax collector and report that we made a 50 shekel pre-tax profit. Now, if we were a salaried employee or an employee working on bonus, I think it's clear that the FIFO system would make us look like more of a hero than the LIFO system, because we could report 50 shekels of profit instead of 30 shekels, and our bonus should therefore be bigger. On the other hand, if, as you, as I do, believe that Ben Franklin was right and it's our patriotic duty to minimize taxes, clearly the LIFO system is superior because we only paid 30 shekels here where we paid 50 shekels under this system. However, beyond the impact on profit, there's also the impact on cash. But let's see what the cash position of the company was after making this transaction. Notice that under the LIFO system, 200 shekels came in, and we gave 30 of it to the tax collector, and so we must be left with 170 shekels of cash. Where under the FIFO system, 200 shekels came in, and we gave 50 of it to the tax collector, so we're left with 150 shekels of cash. Well, if inflation were to continue, the next pair of shoes might cost us 160 shekels. We wouldn't even have enough cash to replace the inventory we sold under the FIFO system. Where under the LIFO system, we could replace the inventory item we sold. It would cost us 160 to do it, and still have 10 shekels left to pay the bonus that we're after. So from the standpoint of cash flows, cash in hand at the end of the day, LIFO clearly gave us a better result. We ended up with more cash in hand because we managed to find a way to pay less taxes. So in addition to impacting profit, notice that the two systems impact cash flows differently. Now, I didn't mention it, but obviously we could have used average, in which case the average number would have been 120, and the result would have been something between these two, and so it's of no great interest, but some companies do use average inventory valuations. The other impact that we discovered we could make on profit due to the system we elected was the impact we could have on depreciation. If we used accelerated depreciation, we decided that might indeed reduce our taxable income. Let's see what impact it also has on cash flow. Let's take a very simple example. A company buys a machine for $100. If you like big numbers, put extra zeros after it. Everything, $100 for the machine. We think it has a 10-year life, and let's suppose we figure it has no salvage value, so we're going to write off the full $100 in 10 years. One way to do it is to charge off $10 each year, straight line depreciation, a $10 charge each year. Another possibility is to find some way of accelerating depreciation, that is to charge more in some years and less in other years. One technique is called the sum of the years' digits. All you do is take the number of years, 10, add up 10 plus 9, that's 19, and 8 is 27, and 7 is 34, and 6 is 40, and 5 is 45, and 4 is 49, and 3 is 52, and so on down, and get a total sum of all those numbers, and then take, for the first year, 10 55ths, which is what it comes to, 10 55ths of the total value in depreciation, something better than or approaching 20%, even though under the straight line basis we'd only take 10% the first year. Then the second year we'd take 9 55ths and so on down. Well, then we could use accelerated depreciation, and I'll just make up some depreciation figures just to show you what might happen. Let's suppose that back in the example with the shoe business, we were actually making the shoes and we had some shoemaker equipment we were depreciating. So that when we got to this point before we calculated pre-tax profit, we'd have to insert an item called depreciation. Well, can you see that if we use accelerated depreciation, we'll get to charge off a greater amount in the first years, resulting in a still lower taxable income, resulting in a still lower tax, but of course also resulting in a still lower profit after tax. But in terms of cash flow, since depreciation is not a cash charge, that we didn't spend any money on depreciation, we're simply charging it off so that we can pay the tax collector less. It's still a situation where 200 came in and the only thing we handed out was 30 shekels. However, it wouldn't even be 30 shekels because with depreciation, particularly accelerated depreciation, we'd have less to pay the tax collector. Let's suppose our depreciation charge in this case was 20 and in this case 10. Now the profit before tax would be reduced down to 40. The tax collector gets 20 and we're left with $20 of pre-tax profits. In this situation where we charge 10 shekels for depreciation, the profit now comes down to 90. We give 45 of it to the tax collector and we're left with 45 after tax. But in terms of cash flows, we're still better off under the accelerated depreciation thing because we really never spent that money. We just used it as a way to defer taxes. Now remember, that's going to catch up with us. It will catch up with us in later years when we don't have much of a write-off. In the very last year, we only get to write off 1/55th under the sum of the year's digits of the value of that machine. So the attractive part about using accelerated depreciation is that it improves cash flows up front, but the price you pay is that cash flows in later years will be diminished. We still have another interesting problem to face given our LIFO inventory valuation system. And that is, what happens if we have a really good year and don't sell one pair of shoes but sell 2 pairs of shoes? Well, can you see if we do that, we would have 400 shekels coming in. We're selling 2 pairs of shoes. But, and this is the big but, not only are we selling the 140 shekel pair, but now we're beginning to reach back into the inventory and sell cheaper shoes. So the total cost of goods sold is not 140 but 260. And therefore our profit margins begin to improve and we begin to have to pay higher taxes because we're admitting that we're selling some of that older, lower valued inventory. This is called a LIFO liquidation. When we begin to reach back and liquidate inventory that was carried on a LIFO, a last in, first in, out basis, we begin to reach back in the stack and sell that cheap stuff, and the result is we're going to report hellacious profits and pay the tax that goes with it. So if we ever liquidate inventory, if we're on a LIFO system, it's going to catch up with us. Now, in the normal course of business, if we replace inventory as fast as we sell it, we won't run into that because we'll always be selling the most recent pair of shoes. Always the last ones in are the first ones out. But if we ever get out of that business or deliberately allow our stock level to fall in this particular stock item, then indeed we will have to report greater profits and pay the tax collector. That wouldn't please Ben, but of course it might please the boss and the shareholders because we'd be reporting better profits. So cash flow is influenced by the choice of the valuation system on inventory, and it's influenced by the choice of the depreciation schedule, accelerated versus straight line depreciation. Not just profit, but also cash flow. Each organization, besides preparing the statements that I showed you for XYZ in terms of income statement and consolidated balance sheet, will normally also include a cash flow statement. And they'll start with, here are our profits, and then they begin to add back the non-cash expenses to get to cash flow. And then they tell you what they do with the cash in the same statement. We might have used some of it to invest in more inventory. We might have used some of it to buy some machines. We might use some of it to pay off some debt. All sorts of uses cash can be put to. On the other hand, we might have also freed up some cash. Maybe we got rid of a couple excess automobiles and got the value out of those cars. That's an accretion or an increase in cash. So the cash flow statement simply not only explains what the cash flows were, but sort of what we did with the cash. And down at the bottom line of the cash flow statement, that bottom number better tell you what happened to the cash account for the year, because that's what it purports to say. These were the cash items coming in, these were the cash items going out, and therefore the bottom line is the change in cash. And so we better be able to explain how cash changed from 94 to 95 by looking at the cash flow statement. In some cases, it's more interesting than the income statement and the balance sheet, but it's a little bit beyond the scope of what we want to deal with today. But remember, cash is king. And the management of working capital, which is part of the way we invest cash, has become a very critical issue with management because there is a cost to working capital. We do have to pay for the use of that money, and it's not necessarily the most productive assets we can have. How do you tell the troops that you want them to pay attention to it? You charge them for it and take it out of the bottom line of the division operations. Now, there are other things that influence the performance of the business that we started to touch upon when we talked about the nature of fixed and variable costs. Remember, we said that the name of the game was to keep the plant as busy as possible. In fact, we would stretch to do that and perhaps even sell widgets as cheap as 601, a penny more than variable cost, if that's what it took to sell more widgets. And we discovered that when you have this operating leverage that's forcing you to do this, that the attraction of making more sales is that profits seem to rise faster than sales because of the leverage of fixed cost. It might be interesting to look at that again, this time in light of the actual cost per unit. The screen that you're looking at now shows you the total unit cost to produce a widget, which is simply the unit variable cost. That's, remember, raw material, direct labor, energy used in the production process, and perhaps the commission we pay to salespeople, if they're on commission, plus the share of the fixed cost that each unit is asked to bear. And the way we'll share the fixed cost is to simply take the total fixed cost and divide it by the volume produced. So the more volume we produce, the more we can spread the fixed cost, and therefore the lower the total unit cost that we incur. And that helps to explain further why profits ought to go up percentage-wise faster than sales. Can you see that not only are we selling more units, but apparently the cost is going to come down because we're going to spread fixed costs over more units, and therefore each unit is going to cost less to produce. In the original example, when we went back and said we had $6 of variable cost and we had $20,000 of fixed cost, and we were spreading it over 10,000 units, the total unit cost to produce each unit was $8 per unit. 6 of variable costs and a $2 share of the overhead or fixed cost that we had as a company that had to be borne by each widget we sold. But when volume went up to 11,000 units, we still had $6 of variable cost, but now the $20,000 of fixed cost is being spread over 11,000 units, and the total unit cost I leave you to calculate is clearly going to be less than $8 a unit. So not only are we selling more units, but we're selling them units that cost us less to make per unit. And that may explain, in fact does, why profits go up faster than sales do when there's an item of fixed cost. More sales and a lower unit cost, total cost, because we're spreading fixed cost. The combination gives us what we call leverage. That leverage is financial, you'll remember, if the fixed costs are financial costs like interest. It's operating leverage if the fixed costs are fixed costs like depreciation. Ordinarily, it's a combination of the two. Remember that when we went down to 9,000 units, we'd have to spread the $20,000 not over 11,000 units, but over 9,000 units, and that's something over $2.20 a unit, so the cost would go up to $8.80, where down here it was down to probably about $7.80. So when we drop in volume, not only are we selling fewer units, but each unit's costing us more to make. So clearly profits are going to drop. So the name of the game when you have fixed costs is keep the thing busy no matter what. Well, not quite no matter what. No matter what, as long as we can realize at least variable cost from the sale of the unit. If we can achieve variable cost and a little bit more, we're better off to stay busy. Now, economists like to talk about economies of scale. In reality, all that an economy of scale really is working the plant hard enough to spread the fixed cost over the maximum number of units possible. If the plant stays busy enough, we spread the fixed cost over more units, and the average unit cost comes down, and the economists are very happy and talk about economies of scale. Simply keeping busy so that you can spread the fixed cost. However, there are some other things about scale that are important from a managerial viewpoint, and those are worth discussing, and that is, how big should a plant be? We'll discover in a later session that these numbers get to be very important when you begin to scale up and build bigger plants. But how should a plant be? How big should it be? Well, a good example is a petroleum refinery. When you make petroleum, like it or not, you produce other products. Typically, when you produce petroleum, you produce gasoline, heating oil, and kerosene used as fuel in jet engines. And so we take a crude oil feedstock and we put it through some kind of refining process and we get these three products. Unfortunately, at the same time, we always get some byproducts. I'll just show one in this case. Let's call it byproduct A. Now, the least efficient use one can put a byproduct to is to burn it as energy. Much better use is to make plastic or some valuable material out of it. So it would be very desirable, in order to make this whole refining operation economic, to find an application for product A. Now, we might do it ourselves, but better yet, suppose we could convince someone else to build a plant that would use byproduct A as the feedstock for his plant. Well, okay, so we'll build a second plant using byproduct A as a feedstock, and this fellow will be producing a couple products. Let's call them product 1 and product 2, and incidentally, although he doesn't want to, he'll produce some additional byproducts. I'll show it as byproduct B. Now, he's faced with the same dilemma that we are. That is, he'd like to see an efficient use for B rather than burning it. And so there's no doubt that he'd like to find somebody to use byproduct B as a feedstock for his process. Unfortunately, this guy wants a big enough plant to make it worthwhile, which means he needs a lot of this byproduct B to operate the plant. Well, that means that our principal customer wants to build a bigger plant and produce more of 1 and 2, and incidentally, therefore, more of byproduct B. But if he wants a bigger plant, he needs more feedstock, which means we need a bigger plant to produce enough of byproduct A to run the whole operation. And this is why petroleum refineries tend to get bigger and bigger and bigger. An alternative is to co-locate several petroleum plants so that we have several byproduct A's, that all of which can feed into this guy's plant to make it economic. But world-scale petroleum plants, by their nature, have to be very large in order to get efficient use of byproducts. There are other analogies for this. For example, when you produce copper, you produce sulfur as part of the refining process. Again, if you want to find an economic use for sulfur, you have to build the refinery for the copper on a very large scale. There's a lot of other arguments for building on a big scale. For example, in a paper mill, the Fourdrinier machines, the large paper-making machines, typically you'll see 2 or 3 of them running in parallel. The reason for this is that the most expensive labor in the plant are the mechanics who keep the machines running and who set up the machines for the next run. If you only had a single Fourdrinier machine in the plant, most of the time these expensive mechanics would be sitting around with their hands in their pocket. A fixed cost, if you would, because the mechanics are on salary, that's not being utilized. And we know the name of the game is to keep fixed costs busy. Well, one way to keep the mechanics busy is to have more machines for them to worry about. So typically in a paper mill, you'll see 2 or 3 machines in parallel. The same thing applies to a steel mill. You'll see several rolling mills running in parallel. There are additional arguments for making plants big. The individual machines that are running in parallel might need some very heavy and very expensive support equipment, perhaps cranes to lift the rolls of paper that go into the machines, in the case of the paper mill. Well, Perhaps we don't need a crane for each of the machines, but we could have one big crane that could serve all three machines in turn. Similarly, the machine that makes the pulp that gets poured onto these machines, one large machine might be able to serve three paper-making machines. And so the combinations of what are the efficient sizes for different parts so that you get full utilization sort of dictate that you operate on a large scale. In a later lecture, we'll discover that there are some specific economics that say build the plant big. Now, it should also be obvious to you that there are some limitations in how big you want to build, if nothing else, because if you had a fire, it would be a real catastrophe. At this point, I'd like to introduce the materials that we're going to be talking about in the next lecture, because I think it will be of particular interest to you to do some preparation for the next lecture so that you'll be comfortable when we begin to look at the U.S. Steel Annual Report. We're going to be going back and forth in that report and discovering a lot of ideas, and in order to do that, it'll be much better if you're already familiar with it. So I'd like to talk to you a little bit about what it means to make steel, and also to give you a few questions that you might want to think about before you turn into the next lecture. U.S. Steel is the largest steel company in the United States, and at the time we were interested in it, it clearly was the largest steel company in the world. This was 1972. I chose the U.S. Steel Annual Report because years ago a friend and I, a colleague, did some work on this, and this is a model of full disclosure. There probably isn't a better report in the world in terms of telling the shareholders exactly what was going on. Very few firms go to the bother of telling people quite as much information as U.S. Steel does. We're going to be looking at it as a way of summary of all the things we've been doing and talking about as we've looked at annual reports and looked at financial statements. We'll be looking, as I mentioned, at the U.S. Steel Annual Report for 1972. Now, steel companies operate on a very large scale for some of the reasons I just mentioned. Efficient use of the supporting equipment, better use of the mechanics, greater use of different kinds of materials so they can produce more than one product at a time. All sorts of arguments suggest that steel companies should operate as capital-intensive, very large facilities. Steel is produced by combining coke, that's coal with some of the garbage taken out of it, limestone, and iron ore. Very large quantities of these materials, which are of low bulk value and therefore relatively expensive to move around, have to be assembled at a steel mill in order to make steel. Interestingly, when I was a student, a colleague of mine actually produced a model that could locate all the steel mills in the United States. What he did was to take a large map of the United States and spread it out on a table. And every place where one of the raw material sources was available, that's the coke, coal, limestone, and iron ore, he drilled a hole through the table, through the map. He put a string down through the hole and attached a weight on the bottom that was in proportion to the cost of moving that kind of material around. Then he pulled the three strings together and tied them and let them find their own center with the weights pulling on the strings. And he could locate every steel mill in the United States within about 3 miles. Now, the only thing it didn't do is to take into account you also want to be on a waterway for several reasons. Steel making requires a lot of water, and secondly, moving by water is a cheap way to do things. In fact, we'll discuss this in a later lecture. And so locating on a river makes good sense. But he found Pittsburgh and he found Chicago and every other location. And somebody else duplicated it using springs instead of weights one time. But I thought it was a pretty clever analogy. In any event, you can locate steel mills, and basically they're located to minimize the cost of assembling these three raw materials because it is expensive to bring them together. Basically, you sort of bake them together. The limestone provides something to take the garbage off with, and you pour it off as slag. And what you're left with is relatively pure iron, which we call pig iron. Hopefully, we get as much carbon as possible out of it, and then we put a tiny bit of carbon back in it while it's still melted, and that makes it steel. We can also add alloying agents like molybdenum and chromium and other things, which make it much fancier, stronger, gives it other properties like stainless. So basically, this is the steel-making business. Steel, of course, it's argued we're in the steel age. Everything that matters that we deal with has steel in it. We talked about the Honda earlier in another session, and you realize that 90% of the weight of a Honda is steel. And if the thing doesn't fly, the chances are that 90% of the weight of almost anything is steel. So this is the steel age, and everybody uses it. But what that means is that steel effectively is tied to the economy and therefore is a cyclical industry. That is, because the economy goes up and down, if nothing else because the Fed keeps messing around with interest rates, then the sales of steel go up and down. Everybody who uses steel needs it, and he needs it when they want it. They don't want it lying around because there's a lot of it. And so they want just-in-time deliveries, but to ensure just-in-time deliveries, you have to order steel well in advance. In fact, typically 18 months in advance was not unusual in this period. I should warn you that in the years since, the steel business has changed substantially. We now have what we call mini mills that are very responsive and can give you materials in the shape you wanted on 10 days' notice if you really need it. But back in this period, the large auto companies and other people who use large amounts of steel would typically begin to place orders a year and a half in advance. Now that was important to U.S. Steel because it meant their sales forecast could take into account that they knew not only what we were going to do this year, but had a pretty good idea what kind of year the next year was going to be. Needless to say, the deliveries had to be on time because if you were running an auto plant and the steel didn't arrive, you're out of action. And the auto plants don't want to stock materials. The analogy to the oil business is kind of interesting. When you build these large refineries, you protect yourself against stockouts by having huge quantities of raw material at the front end of the plant. Just in case the tanker doesn't arrive with more crude oil, there's lots of tanks at the front end with crude oil already sitting there that you can revert to use to run the oil refinery. At the other end of the steel mill, we don't want to store the steel for any length of time, although steel takes weather pretty well, so we roll it up in a big roll and throw it out in the yard and let it sit. As long as it doesn't sit too long, it doesn't get rusty. In fact, if it's stainless, it won't get rusty anyway. Back to the analogy of the oil refinery, though, they have an additional problem. That is, the products they produce are seasonal. You use more gasoline in the summertime and more heating oil in the wintertime. Yet you're producing a constant mix of these products, and so it means you overproduce some products in the summer and you underproduce others, and vice versa in the winter. So the answer to that is they stock large quantities of material at the other end. Incidentally, if you were a spy up in a satellite, you can always spot an oil refinery because there's lots of white circles on the ground. That's the top of the storage tanks that are painted white to reflect the heat. So if you look down from a satellite and you see a lot of white circles, there's a refinery there somewhere. Well, the steel mill is a similar situation. What you see is a large yard, and incidentally, you tend to see a lot of smoke, although in recent years we've cleaned that up too. Well, here's the steel mill then, producing steel from raw materials that it just can't afford to stock, so they arrive on a continuous basis, and then producing a product that has to be delivered just in time at the other end. But at least they know what they need for the following years. Well, what questions should we be asking ourselves as we approach the U.S. Steel Annual Report? Remember, I told you in a previous session that the way you get information out of financial reports is to take a set of expectation to those reports. If you have an idea what ought to be there, then the difference between your expectations and the reality that you find is the important set of information. That's where you get ideas. With that in mind, I'd like to give you a few questions that you should work on and think about before you turn on the next lecture. The first one is just how well did U.S. Steel do in 1972? What did sales look like in 72 compared to 71? How much did they increase? Remember, I told you that not only do we want to take expectations to the annual report, we're very interested in changes. So the first question is, what percentage change occurred in sales for U.S. Steel in 1972 over 1971? The next question I'd like you to take into account is, what should that do for earnings? Now remember, we suggested that this is a capital-intensive business. Sales were up. What should happen to earnings? Should they go up the same percentage? Should they go up less? Should they go up more? And what, in fact, did happen? The next question is, given the results in earnings, what should happen to the dividend? If earnings were up, should the dividend increase? Should it remain the same? Should it decrease? If earnings were steady, what should happen to the dividend? And even more specifically, if earnings were to drop, what should happen to the dividend? The next question I'd like you to think about is, if you change the dividend, how does Wall Street react? What happens to the value of a stock if it changes its dividend, both up or down? The next question is, what was the effective tax rate that U.S. Steel paid in 1972 on its earnings? Now, some of you may not be old enough to remember, but taxes used to be even worse than they are now, if that's possible. And in fact, corporate taxes at that time were probably around 52 or 53% on income. What effective tax rate did U.S. Steel pay? Now, as you answer each of these questions, you'll probably want to leaf through the report. What we've done is to extract about 10 pages from the U.S. Steel Annual Report from 1972, which you'll find in your appendix. Leaf through the report and find out where these things are reported. A word of warning, the most interesting things are to be found not just on the income statement and balance sheet, but buried in the footnotes. Remember, the interesting things are always in the footnotes, and one word of warning, the most interesting things are always in the smallest letters. I think that's because Gottrocksbach here, the richest guy who owns all the stock, probably doesn't have good eyesight, and if we don't want to show him everything, the thing to do is to print it small. There's a couple other things you should know about annual reports, which unfortunately we're not able to show you here, but I'll show you a copy of the annual report when we get to it next session. Any time that the annual report is on slick paper and in color, earnings are up. You can say that with certainty. You don't even have to open the report. If earnings are down, the company will always produce it on plain paper in black and white, nowadays on recycled paper, although that wouldn't have been the case in '72, to show that they're economizing. So one of the lessons you'll learn when we look at the U.S. Steel Annual Report is to discover whether things are good before we even open the report. But remember, I told you, you want to take a set of expectations to the report. So indeed, the ability to recognize that earnings are up or down just by looking at the front cover is a very useful one. You can always make a bet on it. Well, I wouldn't make bets on it. There are lessons to be learned from that. Somebody was telling me the other day that the surest way to know when to sell a stock is when the CEO's picture appears on the front of Time magazine with a favorable headline. Any time that the press gets around to saying somebody's good, it's already too late. And so the company usually dies the next year. So be careful about expectations, but at least in the case of the annual report, if it's got a slick cover, you're in pretty good shape. But of course, when you complete this course, I expect you to do more than look at just the first 2 pages of the report, which are always in pretty graphics, and usually have a letter from the president or the CEO congratulating himself and his company on the great job they did under the circumstances, and also telling you that he's very grateful to the employees for the good work they've done. So we're going to be looking at this report. Please get very familiar with it, because we're going to be leafing back and forth. You'll discover we've annotated the report, which will make it much easier for us to get to the particular things we're trying to get to. Good luck with your work.